S&P 500 daily chart. Today's date 9:50 a.m. Pacific Standard Time, 7/16/2011. We have an S&P 500. We're also in the quarterly earnings. We had the first week Google blowing out the numbers. Yum Brands did well. JP Morgan did well. What we're here to talk about today with MMTs on a standard platform. This is not their platform. Their platform has all of this already built in it, price and everything. What they're going to learn is how does a index start to build weakness from a bull rally to a pullback, but is that pullback strong, or is that momentum weak, or is that momentum strong? One of the things they're going to learn here, that within the double bottom structure as we did, is that the current environment is that when we were saying short the S&P up here, that in the cycle pattern, this bar right here and this bar right here, the percent DS is 93.94%, versus when the percent DS on the break over here on the S&P was at 11.13% at the first bottom, but the percent DS had gained momentum to 44 from 11. That meant that the bottom was putting in strength, and we call the bottom on here, but we got to the top where in the shorter term you reached 93% there. You reached a peak on your MACD level at 9.714 ratio high. What has happened and where the weakness is when this MACD MMTs decline. You can see here 8.91. You can see here on the third bar you got 7.7, and you can see here that you dropped to 5.6, and finally MMTs you're at 5.1. So from the peak, when we put in the high, and this is all standard stuff of how the public makes their reactions. It's not how you do it. Yours is already built in this right here. So MMTs, let's take a look at our platform on a daily level, which has everything that we're talking about. That whole public model is already priced in each one of these lines. And this is a daily chart in our platform of, here, let's put in our historical data here. Wow, look at those gauges popping. So what you see over here, this already priced that in ratio-wise. The ratio high was 77 on that day of that reversal, and it started to come down. The system here will tell you that the bid and ask was deteriorating ratio in your platform. What is that? That's this right here. SMF bid and ask ratio when they're populated. That they had hit a high and they started to mathematically go down. They did not lag. The thing MMTs, these lag the movement. That peaked here. But by the time people start getting in, is that before it will ever get to a sell signal below here, this line, is that they'll miss that whole move down here. So our system is quite different. It doesn't lag as far as understanding that we have come back down here in our system. We have tested a crucial area here. What it is that this is how the bottom looks in our system and how our system works, and how these diamonds had triggered the buy. It doesn't lag the strength. It doesn't lag the strength, and it doesn't lag the weakness in price or the strength in price. What it does do, though, is it tells you exactly where that trend is and how weakness has built itself into the S&P. From an overbought process to a pullback. But the up moves have to change. The public is going to make, you can see that the math here in that MACD had declined to 5.14 from 9.7 all the way down on a daily level. And it had hit a ratio high that the SMF platform deciphers it much better because it lags. And yes, the next day it went down to 8.9. Okay, and we have built the weakness to the current level of 5.1. The public is going to make decisions, MMTs, between the buyers and the sellers, institutional, hedge fund managers, floor traders. They're going to make decisions here. Now, the standard technical analysis is that the S&P had a bull rally, as we called it. We have pulled back in this bull rally to the daily moving averages. Now, here is the thing. The 100 and the 50. The yellow line is the 100. That's a 50-day moving average. And then you have the red one is a 20 and a 10. And that the current high of this pullback has weakened. Meaning that how does a bull breakout trend, whether it's 15 days, 10 days, 5 days, but where does that weakness come in? The more that we deteriorate here and go lower, the weaker that this will be and people will sell more. If we break below the moving averages, stop market orders will get triggered, but the strength of it that the public model will use, they'll be looking at this, the big people, okay, and standard technical analysis. The percent DS in the cycle, it's not overbought, MMT. Remember, when we were at 93, we were overbought and we had to come down. It would apply to an equity. All of this would apply to an equity as well. Here, at the current level mathematically, from 93.94, we're at 58.64. So within the daily breakout of that bull rally to where we're currently at, is we're not nearly as overbought as we were, so we have worked it off. The key is right here, if we keep declining, more people will be selling. The lower that the percent DS and the MACD go, the weaker the overall consolidation is going to the left side of the market. And what do I mean by that? Well, it's this right here. You're descending. See the line going that way? That reflects this coming off the overbought process. The strength is diminishing in value. It's descending. See it? Down here. What we'll be looking at is where we actually hit on the ratio where that public is going to want to get net long. As far as what this means on the S&P, still remains in a bull rally. What will end up happening if we break below there and that gets weaker, more people will start to exit and sell. Because the original bull rally, and we're in an earnings season, so the earnings season is going to cause lots of gap ups and lots of gap downs, and the debt ceiling and all the crap going around is what it is. However, we're only focused on this rally when we put in the bottom and where that rally is in the bull rally. That was a bull rally, short-term bull rally. And from the short-term bull rally overbought to right back here is going to be that major trend line at 1300. If we break below it now, if we break below it and this goes weaker, there's going to be more selling. And we're going to come down and test lower support level. Now, on the other flip side of that, if this mathematical number here for those big decision makers, as far as hedge fund managers and institutional intraday traders are concerned, 1 day, 3 day, 5 day patterns, 7 day, 10 day patterns, price action, is where are we going to get? We have to gap up above it. This cannot go down. If this doesn't go down, they're going to want to buy it. If this gets weaker, they're going to want to sell it. If this percent DS declines, that means that the more that we decline, the weaker that the price movement is in the S&P getting weak. The important part of the trend line here is going to be where they're going to make reactions. That 10-day moving average up above here, we sold into it once, twice, and slightly below it 3 times. And we're descending. That's where weakness is building in this current 4-day consolidation. It's going to the left. Now, having said that, when we go to the weekly on the S&P, we do is we look at this weekly, and the weekly chart right here is going to show you where the weekly MACD was at its finest, was at right here at the bottom on a weekly level is 28.52%. We came up here and made the top on a weekly level at 54%. The ones that people know how to work and understand the most is going to be that daily one that I showed you up there at 93%. that 54% from 28 to 54 ascending is part of a weekly overbought process. One of the things is you got a declining 10-week moving average, meaning that when we were at the bottom and we called that big breakout, we came up and we got above it. Now, this officially counts for 1 week above, 2 weeks above, 3 weeks above. SMF developed a special bull and bear cycle, mathematical cycle, as to what a bull trend is, to what a bear trend is, and a qualifier. The qualifier is when you break below a 10-week moving average and it starts to decline, that descending weekly moving average, as we were breaking out to the all-time high, we were still descending in the 10-week. That meant that this whole top was weak when we got here, and we were going to get this pullback, that 10-week declining moving average. That's what the public is going to look at. And basically, we're sitting crucially right here. Ken flag, 1311.28 is the 10-week. And Ken flag, 1317 is a 20-week. Okay? So get those recorded. Now, MMTs, check it out. From looking at the daily one on it is that we have built weakness in, but we got earnings that are coming out, and it's going to be volatile. It's not going to be your normal trading week. And we are currently building the weakness here, because if I show you where we're at now, we're at 53%. Once again, up here, 54%. So we made the peak and we're starting to drop there. But let's take a look at this MACD bar on this, and this is a weekly chart. The week started 710 up to the current, today 716. But look at here. That MACD here is 16.9 on a weekly. And these are a little bit different readings than the daily. But it's declining from the weekly peak of 17.9 to 16.9. Okay? What will end up happening in the S&P is that it's going to take a lot of great earnings, but if we start to sell through the 10-week, you're going to get more selling. That people are going to start, hey, I need to get out of here. Here's the daily to this weekly move. That's that. What we call that in standard public stuff is that we made that big high. We made that 10-day bull rally, and we went into 15-day period, just ended yesterday, is that we have what we call a weekly reversal from that bull rally. The thing about it is if we gap down and we sell through the 10-week moving average, more sellers are going to hit the market. Okay? The process that you want to know is they always start with this kind of a weekly reversal. And standard people could say it was indecision. It was a doji. It's confirmed with the gap down to support. We're at a major support level of this weekly breakout to the weekly reversal. The trend cycle itself is relatively strong. The mechanical part that you need to know is how that's going to sell through or consolidate above. If we consolidate here, and it's so you drop down, then you go up. You drop down and you go up. That's called a consolidation. That means the S&P has got building strength at a new consolidation level, just as it did over here on its 2-day consolidation level. What we're looking for is the diminishing, so that's the bull, but the pullback is not nearly as big yet. We'll find out next week. Earnings season, you get Apple or IBM to miss the earnings, you're selling through the S&P. You get some contagion or a debt ceiling part, this S&P is at big risk. So I'm going to call for the S&P at a this is the final week. When we start the next week, if we start to sell down below these daily moving averages over here, you're going to come through these weekly moving averages. There will be programmed stop market trades that hit sell signals by the bigger people that generate them down, and you would get more weakness in the S&P. On the other hand, if we consolidate here and we get good bottom line growth in the earnings, we're going to consolidate and we'll break that high. Or we'll sell through back down to support. Because of the earnings are in the picture, it can go either way based on headline events that will generate or create or promote emotional transactions within the broader S&P 500 stocks. There's 500 stocks in the S&P 500, and we're going into the major earnings season. If we do well on the bottom line growth, we will look for a higher move here and a consolidation here. The current level is a 1-day reversal, 2-day, 3-day, 4-day, 5-day pattern of the pullback versus the last 1 day, 2 days, or let's go over here. 1, 2, 3, 4, 5 days here. So this is a counter trend to that last 5-day top, and this is what it looks like. But notice that the buy side conviction on the daily bars were much more powerful than we're getting the weaker selling conditions. These are not big sell. If we were really going to be extremely weak in the S&P, you need to see we did have this big distribution bar, and it was greater than the last breakout bar. That's where the momentum is slightly weaker than in price right now, than being more bull in price because of that daily haircut up here at the high. And so on that daily level, the high was 1343, and the day's low on that S&P reversal daily was 13.16.42. So from the top down to the bottom, point wise is where we started to build in the weakness, but they've been very narrow ranges, and we had a counter trend right here where we hit 1307 and we came up to 1317, so it was 10 handles up above these key moving averages. When we get down to the bottom of the consolidation, what we're looking for is a sell through to the downside and or a gap up and a new consolidation, and how that 10-day moving average would be taken out. It's going to take a lot of good earnings. It's going to take a lot of high volume momentum. It's already sold off. It's had a lower high pass right here and sold down from top down. The top down here was 1326 and the low was 1306. That was 20 handles from the top down. See, here from the top down MMT, it was 1331 to 1314 top down. This is how price action when it's top down, selling from the top down, and the selling from the top down, and the selling from the top down. That is how you know that the current consolidation is weaker than you would want it to be. It's not a bull consolidation, because it's from the top down. It's not from the bottom up. Here, you only have a 1307 reversal to a 1317, 10 up. From bottom up is 10. But you look at the amount of equations mathematically that you have. Now, having said that, your platform here already has it priced in. All of what I'm talking about. And in this platform here, when you go to the peak right here in our platform, the half bar was 1348 on the S&P on a daily level here. I'm sorry, it's a daily level, but the half bar was 13.48. In your platform, the way you're taught outside of that other stuff is that when you look at this daily bar here, you can see down here that the closing half bar was minus 23.56 handles. Yeah, from this half bar down. This, now check it out. Here's this half bar right here on a daily. It's 1343. That's the half bar, or the distance from that up to that 1343 is your half bar. But look at here. The following day, MMT, the following day, right here, this is this big down bar right here. The net equation on 714, it was $14 below half bar. This one increased to 23. So you're increasing, then you know that weakness is there. You can also see that every time here that you shoot up to test this half bar at 1329, you can tell that that half bar, daily bar, is selling in the S&P, but every time it's building weakness to this current level. and that it must consolidate now and get that bottom up process. You have more bottom up than selling down. You got to get positive bars above this bar right here. This bar is right here. This bar, this daily bar is 1316.70. That means that you're still 14 handles below the 714 daily bar. That's negative. That's weakness. We understand that. So we also understand now that we have a Friday bar is that the closing half bar here is only minus 0.56. The half bar is 1312, and we close at 1316. This is the natural state of this half bar. And so we can see within the current move on Friday that the closing half was not continuing to go down like 2.5 below or $4 below it, but we kind of flattened out here now using our platform. What the ratio will be for you is how I close above the previous half bar that sets up new strength from the original reversal that we called for, and that we have to maintain a certain delta in our platform over here on the S&P. And basically right now on a daily level it's minus 1/2 delta. It was minus 1/2 delta down there of the move. So in order to get positive, the S&P has to get up to 1321 and consolidate here. Half delta, 1326 is a full delta up. For Monday, that's going to be 1326, 1331, 1336, and 2.5 deltas up. Back up there would be 1341. And 3 full delta ranges up is 1346. But hey, MMT, on the flip side, if we break lower here, a half delta down is 1311, 1305 on a full, and 1 1/2 is 1300. 1 1/2 delta, we'll put that right here. And that would be a very critical point. But if we go 3 full deltas down, just like 3 full deltas up, 1285 is the lower end. That's 30 handles to your pricing control mechanism here. Okay? And that it will change daily, but these are the negative delta ranges of support, whereas on the flip side, 1346 is 3 full deltas up, and the neutral zone is going to be 1316. A half delta down is 1311. That's negative. So the price in here to the pullback has a negative consequence to it as far as momentum. And all the stuff that I talk about over here and all those public standard indicators are all built in here. But they don't lag. These lag buy and sell signals. This does not. It was an immediate sell signal. Bam. So we understand the differences between the public technical analysis model and the SMF model, which does not lag price action. The model on the S&P in the earnings season is going to be as follows. If we gap down on Monday and we continue to sell through, we're going to break these moving averages and we're going to come right back down there where I showed you in your platform around 1285. That'd be 3 deltas down, right above that 200-day simple moving average. Already got it priced in, sorry to tell you, slightly above it before it gets there. Okay? And that the long-term trend on the S&P remains this 1250 handle right here. Right here. So that's your support, but that 1250 hasn't broke at all this year. And the divergences between all of them in a public model is that they're going to read it is that the S&P has great support right here and that the pullback is very strong. That's how they're going to read it. But remember that their readings and their programming and those high frequency volume supercomputers have already got all of this flashed in there. So they will take a heavy volume and try to run it down, and or if it holds support, vice versa. Intraday, we're going to bounce. We will apply this analysis to trading the S&P 500 index options. We'll go ahead and look at these contracts, the 820s right here. They're both calls and puts that will be applied to this daily and this weekly S&P where we're at in the trend. The public model is going to view it as extremely bullish on the pullback. It's going to take an earnings season to get back above the highs. The bellwethers like Google, you got it out of JP Morgan, you're going to need it out of IBM, you're going to need it out of Apple. I can tell you that semiconductors and whatnot and financials are weak, and the transports are going to have to show up in order for the earnings season. It's going to give its report card on the bottom line. The reason for the lengthy training on this video will have to be cut in half, but we already expired. These are contracts that expire next week that we're going to be trading on the S&P, long and short. And once again, if we're going to get net bull long, well, then we'll be looking at that drop down support level and buy that $1,300 call. It took a haircut for next week's expiration of 34.66%. Okay, and that you can see that you can see some of the readings in here, and we'll go over this in another video, but it's all going to be how do I apply an index option, call option based on strength, or a put based on weakness, and which way is it going to go, and how do I manage my risk both long and short on the S&P until either side breaks. That's the analysis on the S&P moving forward in the earnings season.